All right, ladies and gentlemen, welcome back to another fabulous episode of the Healthcare Trailblazers podcast. Excited to be sitting here today with Steve Wardell. Steve is the managing partner at Wardell Advisors LLC. Find him on LinkedIn. And I had the opportunity to connect with Steven a while back, and we chatted kind of VCs and funding. And Steve's got some really great experience around investment banking and venture and just a whole, all kind of over the place. And we had a really entertaining conversation where you've kind of like peeled back the layers and you know, looking behind the scenes at kind of the equations and the way that a lot of these folks are thinking. And I thought, you know, this would be a really great conversation to have on the podcast for a lot of, you know, any health tech founders out there, anyone that's kind of starting out and starting to talk to VCs to kind of know what are their incentives, what are some of the keywords to keep in mind when you're having conversations with people to know that they're wasting your time, how to know that they're actually taking you seriously, how to know that they're not just brain raping you. And so there's, you know, a lot of fun there. Steven, thank you for taking the time.
Thanks for inviting me on and excited to talk about this with you for your audience.
So let's jump right into Silicon Valley. If I recall correctly, you on our last conversation, you started drawing a lot of kind of the similarities between the show and reality. Let's start there. Think back to the show and kind of, you know, what's real about it and what points are maybe totally off.
Well, so I do think that a way to understand digital health is that it's like B2B in Silicon Valley, but stakes are lower and things happen more slowly. And so digital health is like a B2B sector. It's software selling into the enterprise budgets of hospitals, health plans, pharma. And it's a big sector, but it's smaller than the total B2B or the total B2C sector. And things tend to happen at a delay. So, for example, there was a huge debate as to whether SaaS and cloud would penetrate digital health and whether hospitals and health plans and pharma would agree to let their data be in the cloud. This had already happened 10 years before in B2B, but people were saying, I don't know if it's going to happen in digital health or not. And it clearly was going to happen and did happen in digital health. So things happen at a delay. That can be a good thing. It's a tough sector to build a company in, but that can be a good thing because you can see trends play out. You can see big winners and big losers over in B2B. And then whatever wins in B2B will probably wind up playing out in digital health as well. Now, when I think of Silicon Valley, hilarious show, worth watching again if you caught parts of it in the past. And it's very much the whole thing about the uncertainty of whether what you're building, you know, ought to be a product tucked away inside of a big company or whether it ought to be its own startup, and the uncertainty of getting those early customers and the uncertainty of trying to appeal to VCs and get the attention of VCs. All of that plays out exactly the same in digital health as it does in the Silicon Valley TV show.
So I'll tell you, to me, the most depressing part of Silicon Valley is not the absolute gross incompetence of the team that's shown over and over again, and the kind of, you can almost bet on the fact that they're going to fail at every step and turn. And then there's the fun part, which is the perseverance and the things that kind of come about. But there's no positive outcome, meaning the end of the show is them realizing that their technology is an AI tech that's going to take over and mess up the whole world, and then they shut it down, or they do that thing with the rats, or I don't know, whatever. But it ends up like the whole thing, they finally get there and then it fails. Like, that's so sad.
I think they were trying to figure out how to go out with a boom in that. And I'm just barely remembering, but I think in some of the last episodes, they talked to a young startup person who then vaguely remembers them but can't remember much about them, and they realize that they had this fleeting glory when they were center stage, and that a lot has happened. A lot of water has gone under the bridge since then, and the young people don't know their names anymore. So
yeah. Well, all right. Well, let's go back to the venture part of the show, and there's a couple different scenes where essentially you have Erlich Bachman, who's one of the most entertaining characters on the show, and he's going around with the crew, and they're trying to raise from different VC funds, and they basically came upon this theory that there's an inverse correlation between how nice you are and to the VCs, and then them giving you a term sheet. And so he ends up going around and just being an absolute jerk to all these venture capital funds, and it seems to work at first because they get all these term sheets. Then something goes wrong where then it flips around, and then they all like end up throwing him out and being like, oh, you were so rude. There is, though, and I know that's kind of taking it to its absolute comedic extreme, but there is a lot of talk, and I've talked to plenty of people that will tell you, companies are bought, they're never sold. The second you need money, you don't get the money. You want to take the money when you don't need the money, because the second you need their money, they don't want to give you the money. And it's like this weird dynamic where you have to play this game of like, instead of just having a normal conversation with somebody and be like, hey, here's the value that we're creating, here's the vision, here's how we think, funding can help out. What do you think? It's like, no, you gotta play this whole like mind game. So is there any truth to that? And if yes, what is the strategy around, not seeming needy for money, but also not being a jerk and being open to having the conversation? It seems confusing.
So any entrepreneur is trying to put pieces of the puzzle together, and they obviously don't have everything they need already. They don't have roaring sales already, probably, if they're in the seed and Series A category. And so you need to sort of manage how you interact with VCs so that you're always looking strong to them. So ideally, you know a lot about them in advance of approaching them. You have reasons to think they'd be interested in your particular story, and which is harder if you're truly new. And then you're presenting yourself in a way where you're relatively winning for your stage and for the stage that you're in. And so, and I think there's a story from one of the Silicon Valley legends. It might have been Peter Thiel said, you want to be telling a story about how awesome you're going to be a few years from now, and how the price they pay today to participate in that is low compared to how awesome you're going to be a few years from now. This is hard because, of course, as an entrepreneur, you're operating in a world full of constraints, and you haven't put together all the pieces that you need yet. In fact, you need VC money to go out and get those pieces. So I think that one of a factor to take into account is that some VCs are original thinkers, and they're usually, if they're truly an original thinker, they're often somewhat courageous as well. That's less than half. And then most VCs are sort of following the crowd. And so you want to have an idea of who those original thinkers are. And then ideally, you can get one of those original thinkers their fund is often named after them. That's a good signal that you're dealing with an original thinker. And then they will, out of conviction, invest in you and cause everyone else to invest in you. But most VCs are just following the crowd. And there's somewhat of a good cause for this, which is that when you look at successful funds, it's often that somehow a partner got into a already successful hot deal that went on to greater and greater success, and they stayed in it, and they upped their investment in it over time. And so they're looking for that company that's throwing off all the signs of success. And it didn't matter. They didn't get into it at Series A. They got into it at Series B. And so that's a legitimate strategy, and that seems to have some merit to it. But as a young company leader, you're looking to find the original thinkers, get one of them to commit as your lead, and then the followers will follow in after that original thinker. And you can't always do that. And any fund that's truly interested in you could be your lead, and so you want to.
Some of them don't lead, right?
Yeah, that's right. So often corporate venture funds won't lead. Some funds will say, we're not good at due diligence. If you lead, you have to do due diligence. Some funds will say we're not good at due diligence, and so if you find a lead investor, will be a follower. But anyone with any lead investor who has a lot of interest in you could be your lead. But not all of them are original thinkers, and so you want to be throwing off these signals of success to make them interested in you, what you look like, one of the companies that's going from success to success. and you can attract this investor who's going to be your lead plus other investors.
And is it always a possibility to have a group where you have a lead and then you have a bunch of, and then you can have like a consortium of followers or whatever you want to call them? Or are there these that don't want to share and they're just like, no, we're either in this or we're not in this?
So that tends to be, it's very situational, and it varies sort of from year to year. So there was a period when a lot of funds had new large funds and they wanted to put that money to work, and they said, if someone's raising a $15 million Series A, we'll take, if we believe in them, we'll take all of it. And we have a $400 million fund. We have to rapidly put that money to work. We don't want to create an allocation of $5 million out of the $15 million to give to other investors. That you can encounter that kind of dynamic. At other times, VCs will not have as much money to put to work. And so they'll say, well, we need a syndicate here. Ideally, it's other venture funds that we like and that we trust. We as a lead, we've done this before. We can actually recommend and endorse you to some of these other funds. Or maybe you're bringing a corporate venture fund that earlier in your process said, we'll put $3 million into your round as a corporate venture fund with a strategic interest in this when you find a lead. And then everybody thinks that's a great idea. It's great to have the validation of a corporate venture fund putting $3 million into it, who promises to be relatively hands-off of this company in the future. And that serves as a valuable validation to others and a form of due diligence within a single large player in the industry. And could be a partner or customer for the young company in the future as well. It depends on the appetite that you're seeing, and it'll largely be determined by, it's very hard to get a lead. Once you get the commitment of a lead, the tone they set will determine whether you have a syndicate or whether the lead is taking all of the investment.
Mm-hmm. I have so many rapid fire questions. Just briefly, we don't have to go into this too deeply, but I think there are going to be listeners on here that don't even understand that there's like there's levels, and there's pre-seed, then there's seed, then there's Series A, B, C, D, E, whatever, right? Can you kind of break down what those stages are? Are those stages typically counted at idea stages? Are they revenue stages? Are they all the above? How do you what do those stages look like? And let's just go with pre-seed, seed, and Series A.
So I'll talk here about, say, a software company that sells into payers and providers. That's a big part of digital health right there. And so with seed, usually they don't expect you to necessarily have with pre-seed and seed. And these days, I've actually been hearing them being called just seed 1 and seed 2 and that sort of thing. And the reason is that once you don't want to have trouble with naming it if you have to do a third seed round, for example. And so
what differentiates a seed round, especially if you're doing 1, 2, or 3 from an A?
So oftentimes a seed round is not a priced round, and so you might be using a safe, for example, and the safe simply says that we will convert into a priced round. It's too difficult at this young early stage for either side, the entrepreneur side or the investor side, to figure out a value for this company. And so when it gets into the Series A round, where you probably will have an institutional investor invest, who's well known, we'll let them do due diligence and figure out the price at that time. But we'll do a safe round as a pre-seed and as a seed round into the company, and that's not priced, but that might convert on advantageous terms into a Series A. So usually with a seed round, you wouldn't necessarily need to have a customer. You might, during that process, get an early customer on non-commercial terms, so testing your product at a hospital, but you don't yet know if the hospital would buy a final version of your product at the full price, for example, like a pilot with a hospital, and that's getting you some validation. But you're trying to you're looking for product market fit. You don't have product market fit yet, and so then. Around Series A is when you might have a few customers, and you think you're close to product market fit with these few customers, and then that's and then Series B, I've often heard this called expansion capital, which means that you have a hit product, you found your product market fit, and now you're raising money to expand the sales force, to expand product development and production, and go into rapid growth with Series B. And then Series C is further growth and expansion, but you now have a much more mature product and a full-sized sales force selling it in a known price in the marketplace. So those are some of the examples of those. And then oftentimes a company might get Series C. That's where VCs often tap out and where growth equity steps in. So a VC might have its own growth equity fund, or you might be dealing with a different category of investor, a private equity growth investor who's coming in at the Series C stage or later. And if a company has been successful and doesn't need any, and has turned profitable and doesn't need any more money, after that you might see a crossover round and an IPO round going public or being sold in a trade sale. And it used to be sold when you had 50 million, 100 million in revenue in a trade sale to a consolidator in the industry. In recent years, that companies have had trouble exiting in IPOs or in trade sales. And we may see that challenge getting easier more recently. The IPO window seems to be opening up.
Is that because of the departure of Lina Khan and that whole vibe, or nothing to do?
It's a number of things. So Lina Khan really threw a wrench in big tech at the largest sizes, and she did that for reasons having to do, it seemed like, with antitrust, not wanting to allow in the graphic design, in the digital graphic design industry, not wanting to allow the biggest companies to merge with each other and give customers less choice.
Right.
It seemed to have had a trickle-down effect into much smaller companies as well, but there were other reasons. So there's a big dividing line between 3 years ago and today. 3 years ago, interest rates were at nearly zero, and today the federal funds rate is at 5%. Corporate bonds are at 10%. So back then, 3-4 years ago, young companies' interest rates were zero. So investors really valued growth. Young companies that were growing could raise any amount of money and had extremely high valuations. It was not uncommon to see valuations at 10 times forward revenue, 15 times forward revenue, even 19 times forward revenue. That's huge.
What's forward revenue?
Forward revenue is like, so it could be your year 2025 revenue. So your projection for your year, for your revenue by the end of this year would be a measure. There's multiple measures. People might say forward 4 quarters. That would be the 4 quarters forward from now. It could be run rate, which would be the current quarter times 4, or it could be the calendar year that ends in the near future. So that would be calendar year 2025. What's your revenue for 2025? SaaS startups tend to like, for example, run rate, which is current quarterly revenue times 4. So
you're saying people are getting these really high valuations of 10, 20 times that.
And so these young company leaders were saying, we don't have to sell out to big industry because we're getting a high valuation today and we can easily raise money. And if we were to sell to a big consolidator, we would only sell to them at 15 times revenue, some high number. And that meant that the consolidators weren't buying, because these consolidators, they're often public. They look at this and they say, if I actually pay, is this company really worth this much, or is this some kind of bubble going on in the VC world? And if I actually pay that much, my numbers people tell me that it will never be accretive. My EPS will go down. It won't go up. The relevant time frame here is usually 2 years. You can model it out. If I pay this cash for this company and finance it with taking on debt and having to pay an interest rate on that debt, or issuing shares in the stock market and then diluting my EPS base, will it increase my EPS? And so the answer for these young companies, which were often earnings negative, was no, it won't in the next 2 years. So big consolidators were not buying these young companies, and the young companies didn't want to sell because they wanted to hold out for very high valuation. That was the case 3 years ago. The case more today is that a lot of these young companies who might have 50 million in revenue or more are in trouble. They might be still earnings negative. That's a bad sign. They might have trouble raising money themselves. They're holding out for older, higher valuations that they're not going to get, and then the buyers are having some trouble raising money as well. So buyers would have to finance this acquisition. But oftentimes the consolidator buyers, they don't have a high stock price themselves, so they can't use an inflated stock currency to easily buy someone. And they might have to raise financing, and that's not so easy in today's environment as well for the consolidator. And so now, having said that, a number of subsectors of digital health are ripe for consolidation. There's been over-entry into the sector, and the product buyers have matured in their product buying marketplace, and they would love to buy a suite or make an enterprise buy of one vendor to solve the whole problem for their whole enterprise, or buy a suite of products and have what's called meta functionality, which is things like analytics across all 7 products in your suite, or IT security guarantee across all 7 products in your suite. This is or evaluation of cost effectiveness of the product across all 7 products in your suite, or gamification across all 7 products in your suite. Or integration with Oracle PeopleSoft HR software. This is known as meta functionality. And point solutions who can claim a better treatment of diabetes, they usually can't achieve this meta functionality. Usually only the bigger players who have suites of products can try to do it and do it. And so the market is primed for consolidators to buy up point solutions and sell to the product purchasers. And so we're starting to see that play out. We're starting to see. So an example of this was that Transcarent and Glenn Tolman in the employer health tech sector, they bought Accolade, which is a public company at a relatively low multiple in the market, and they're doing a roll-up there. And then Virgin Health Miles and HealthComp merged to form Personify Health. I think they're doing a roll-up there as well. So we're seeing that normally in markets, you see entry and over-entry of players into markets and products into markets, and then you have shakeouts and consolidations. And this has been delayed in digital health in these sectors, but it's finally starting to play out, driven by market maturation.
Mm-hmm. Going back to just a little bit, is it possible to skip any of the steps? So let's say you bootstrap your way up to like a Series A or a Series B, or do you have to go through the steps whenever you decide to get on the treadmill, so to speak, of raising? You got to start from, you just got to go through the rungs.
You can skip steps. And so one thing I would say is that, remember, if you ever decide to get venture dollars, those VCs are going to want to see you rapidly scale and then exit. That they have a mandate for that. And so if that's not your plan, then you don't actually want venture. You need to get money some other way. And so you're going to give up control of your entity as people invest more money in it and start getting board seats, and they're going to demand that you rapidly scale, and then that they be able to exit in some way, which is typically in a trade sale or an IPO. Or possibly being acquired by a financial acquirer, where a private equity firm buys out VC's interest in the company. And so most young companies do choose to go that way, high potential software companies. And if you're lucky, you will. So it doesn't come along very often that a company is rapidly successful and rapidly profitable. If you somehow pull that off, then you don't need VC, and you don't need to jump on that train. It might be the case that you don't need VC until you're at a company stage that we would call Series B or Series C, and then you have to go raise that money for the first time. Mm-hmm. And if your business fundamentals are really strong because you got there on your own without having to raise money. So what does that mean, strong fundamentals? Well, it means that you have a great gross margin, that you're solving a problem that's one of the top 3 problems for your buyer in the enterprise. It means that you're a market leader. Those are things. Those are must try. The VCs will look at that. You could then go look for VC funding for the first time, and they would love you. They would love you based on those fundamentals. You would lack some things they'd like to see, like prior prestigious investors who are re-upping into the next round, but not as lead investors and telling you to go out and find a lead investor. That's usually a really good sign. And you won't have that because you don't have VC investors, but you don't have it for the best possible reasons, which is that your fundamentals were so good you didn't need venture funding until now.
Right. Super interesting. Okay, let's talk about toxic investors. So what are kind of the biggest, there's all over YouTube, you'll find red flag videos for relationships. Let's talk about red flags for VCs or investor relationships at early, and specifically let's target early stages, because I think the more mature you get, naturally the more choice you have, and I think it's a lot easier to stay away because it's harder to prey on those folks. So yeah, what are like red flags for investors for early stage?
Well, I'd say initially you're looking for, so in a perfect world, to have a venture investor invest in you is like a good marriage. And I once heard that marriages are lasting 10 years these days, and that VC is going to be with you about 10 years. And so the analogy is apt, and you're going to be giving things to them. They'll be giving things to you. They'll be helping you. And in a perfect world, you would have known investors enough, and you actually have to manage. It's very good to meet and talk to many investors, but you need to manage what they think of you when you meet and talk to them. And I can go into that some more. So I'm very much in the camp that you should be talking to investors frequently and get to know them early. There's another camp that says that only show up when you're totally ready to raise money from them. And I think that's usually not the best pathway for that. But ideally, you've found out that they have invested in companies like yours in the past, and those portfolio company CEOs endorse them, and they also haven't, wrecked the CEOs that they've invested with in the past. And there's certain funds. It used to be so common that there's certain funds like Founders Fund that were founded just to be a fund that promised to CEOs they wouldn't screw them over 2 years later. Now it can be in the shareholders' interest to, for example, replace the CEO with someone else. And maybe that CEO is not good at sales, can't help scale the company, then you bring in someone else. But usually CEOs, this is their baby, and they wouldn't knowingly put themselves in a situation where against their will they're going to be removed 3 years from now or something like that. But it's very hard to get true calls with investors. And then when you have those calls, there's often the investors may not be seriously interested in investing in you, in which case you're not wasting their time. They're kind of wasting your time. And you want to manage this as well as you can, so as to make sure you get in front of investors who could realistically invest in you, and not necessarily spend a lot of time with investors who are not going to invest in you. So why would investors meet with you but not invest with you? One reason is that investors only have a small number of themes they actively want to invest in at any given time, but they're always wondering if they should add a new theme. They hear another fund invested in something, and then you're doing the same thing. You show up at their door, and they're like, well, let me be educated about this. I probably won't wind up investing in this new theme, but why don't I do a call, and maybe this guy will surprise me, and I'll be delighted with it, and I will want to. So that would you want that call? Well, that's a marginal case. You might want to meet the investor in the first place for later purposes, but you wish you could know in advance that this person is not realistically going to invest. Another case is where there's sort of chaos at the fund, but the investor has to keep busy but doesn't want to reveal that there's chaos at the fund. It could be as simple as that the fund has a bigger fund and they say publicly they invest in seed and A, but they don't actually invest in seed and A much anymore. But they want to meet the companies that are at seed and A. They don't want to miss the next eBay. But they're not realistically going to, all their investments have been B and C, et cetera. And you can usually find that out by looking up on Crunchbase or one of the big data aggregators that's out there. Another case is that, and this has been true more recently, that they're really having a lot of trouble at their fund. They're having trouble with portfolio companies that can't raise their next round or are struggling with problems around revenue and expense. They can't raise their next fund, and they're down to their last small amount of money. They can't raise their next fund. And there's reasons why they would keep doing meetings, but they are looking to get information out of you. They might even ask you to do homework for them in these meetings, but they're not hot to invest. So there's lots of, and then there's also investors who have just developed a reputation over time of not treating founders and management well. And so they might be eager to invest in you, but you may not want them to invest in you. So those are the different kinds of categories. And what I recommend for people in general is, on the margin, take the extra meeting, even though this fund may secretly have gone later stage and not really be interested in investing in you. The reason is you want to make a good impression on the partner. You want that relationship to start early. You want to learn about how they're investing on the call. You want to turn to the tables and qualify them. And you want to learn industry information that they're sharing, that you can learn from them, even though you were kind of hoping that this would be the call where they're going to be your lead investor, but they're not going to be. There were still other benefits of having invested, and if they're not there for your A round and because they've gone later stage, they might be there for your B round, and then you're in a position of updating them and telling them about your recent successes for the B round rather than meeting them for the first time. But there's a number of kind of ways to tell in a meeting whether they're truly interested. In this, one is that you look up their recent investing history. Now, usually you can't assign the partner without extra work to the investment, but you look at their fund, what their fund has invested in recently, and you're looking for them investing roughly in your sector without their having invested in exactly your kind of company. And the test I use here, I'll call it the bake-off test, which is that when there's a buyer of software, let's say the buyer of software is the head of the emergency department of a hospital, for example, would that buyer consider your two products, you and the part of the company that this fund invested in, to be direct competitors? And if that's the case, then you actually want to be silent toward this fund. You don't want them to know about you. You don't want to send them a prospecting letter. You don't want to send them a deck. You don't want to send them anything. So you're looking at who they invested in. But if that software buyer, you discovered that the fund invested in a young company, and the young company has software they sell to the emergency department of hospitals, and it's the department head who's the buyer of this, who has the budget. And so if that buyer would not consider you to be direct product competitors that do the same thing, then this actually may be the best VC for you, because they have shown an interest in the emergency department budget at hospitals. They think they're going to be spending more on software in the future, not less. They're looking at, they've invested and they've done the work, and they've invested their time and energy into looking at investment theses around the emergency department budget. And they've made a commitment, and they made an investment in that budget. And now they'd like to leverage their human capital. They're now an expert. They've talked to a lot of hospital emergency department heads because they made this prior investment. And they'd like to leverage that knowledge and those contacts, that experience, to invest in your company. They could be the best for you. So that's one area. Whereas if they've never invested in software that sells into the hospital clinical side in general, they never invested into software that sells into the emergency department, then it would be then that's going to be low probability that they're going to be interested in you, because they have to build that expert capacity as an investor in order to make the investment in you, which could take a lot of their time. So that's and then a close area would be if they've sold to the hospital. If this is a fund that is invested in a young software company that sells to the hospital CIO, for example, that'd be an adjacency. That'd be realistic. They might leverage that to invest in a company that sells clinical software to the emergency, for example. So you're looking for that level of focus for your time. Then you do a call, and you're looking on their side for ideally that they have on this call, they've brought in other employees of the fund. So ideally your calls with someone at the partner level, and they've brought in a principal, or they've brought in an associate, or they've brought in another partner for this call. So something about your letter and your deck that you sent them made them think it's worth me bringing in these other people to this call. And then what you're looking for, a number of things. You're looking for a sign of true interest on their part, and there are some ways to gauge whether they're truly interested. But a third thing is, in general, when you pitch them, I like people who start with talking about the buyer, the buyer's world, the buyer's problems, then the market size of the buyer's problems, how modern new technology can provide a better solution that's ever been provided for to these problems, the changing nature of the problems, the flaws with the existing solutions, the special nature of how AI software today could offer a better solution for this problem, the value of this problem to the buyer, etc. And so it turns out that as a young company CEO, you are the world's greatest expert on this topic. If you've talked to buyers about building software for them, if you've sold a pilot, then you have rapidly become one of the world's greatest experts on this problem, the size of the problem, the nature of the problem, how technology can solve the problem. Whereas VCs have to be experts in hundreds of these areas, and they can't possibly be the world's greatest expert in any one of these areas. As a young company CEO, you're the expert in this area. And so instead of coming to them about, as a CEO, I have a problem, which is I need to raise money, and that's why I've come to you. That's not how you approach them. Instead, you say, this market with this buyer, they have a problem. The problem is that patients don't come up at appointments. It's a huge problem, and it means they waste the time of professionals, and you can't get the money back by going after the patient. And so, if only we could fill the time slots of the expensive professionals better using software, we could solve a big market problem that's worth a lot of money. The software, we could charge a lot for the software. That kind of discussion you're not coming to them as a CEO who needs money. You're coming to them as an expert in a big dollar problem that's changing, where there's news about what's different. The problem's different today. It's bigger today than it was in the past. Your solution is better today. Your software is better today than it was in the past. You're an expert. They need to learn from you. You're approaching them as an expert who's sharing what you're seeing in the product market space that's worth a lot of money. That should gain their interest. Then you're looking for them to demonstrate on the call that they actually know about this, that they're going to say, we looked at this 5 years ago, we thought the technology wasn't right. Oh, that's really interesting. That's a true indication of interest on their part. Or they would say, we have a retired CEO who told us about this opportunity and who looks at new companies for us. Can we refer you to this person? That's another example of true interest. Those early slides that are about the problem, the buyer, the changing nature of the problem, the changing nature of the buyer, the changing nature of the technology. You're looking to have a natural conversation about that lasts the entire scheduled time. If you're lucky, you got 50 minutes scheduled time. You're looking to have a natural conversation that never gets to the later slides and that focuses on the early slides, and that shifts from you speaking to slides to you having a real discussion with them, and that winds up sliding over the 50-minute mark with no one looking at their watches and no one suddenly exiting the call. These are signs of real interest. And then And then you're also looking for them to bring up things they might do, connections they have. They might send you a report. They might ask a CEO, a retired CEO, look at your company. They might put you in touch with another partner at their firm or whatever. You bring these up. And then when the call ends, I recommend you do a couple of things. One is that you write down every single question they asked you. And if you're using AI on the call, it can do it for you, or you can have an assistant who's on the call do it for you. But it's going to be the same questions over and over again. And you have to decide how you're going to answer these, which may require doing research, talking to customers, scoping out the specs of an addition to your products, something like that. And you have to decide, are you going to do this homework for the next call, or is it you're going to wait and see if people will care about that, or if you have a simple answer that didn't require any work, is that good enough for the next call? But write down all the questions they ask. It's going to be the same questions over and over again, and then also pause before taking the next step with this VC. And see if they do any of the things that they said they would do on the call. So if they said, if they said on Tuesday, I'm excited to put you in touch with a partner, and then on a Thursday they send out an email to you and the other partner saying, please talk to each other. That's a fantastic sign. So you're waiting to see if anything they brought up on the call, they actually followed up on. That's a sign that they're very serious about you, and that they're not wasting your time, and that they could be your lead investor even. Mm-hmm. So you're looking for that kind of follow up, and it's better that you, in terms of you gathering information about true interest, it's better if you just wait and they do it, rather than if you follow up the next day and list the 4 things that you talked about on the call and ask them to follow up on their part of them. It's better if you just pause and see if they follow up. Yeah. And you can also hint at, if you know that you have a couple sales coming up, you have a possible pilot coming up, results for a pilot, you have a possible sales channel partnership coming up. It's nice to hint about those in your July call, and then when it falls into place in August, you call them back and you say, remember when we talked, you try to get them on their cell phone in this case, but you can also write them a quick email and ask for a call. And you say, hey, remember we talked about that? And I hinted, well, it has arrived. Here it is. And this is you as a CEO getting to show that you did what you said you were going to do. And mm-hmm. where this meeting is that you have momentum, and they'd be lucky to get you.
Super cool. Very informative. Speaking of experts, is there a framework to think about going to a very targeted fund versus a generalist fund?
So one framework would be, with a targeted fund, if you've been in the industry for a while, you may know some of the same people. So it's worth just doing some research around here. And, if you see they made some investments and one of the CEOs, you can bring that person's name up on the call. If they're sharp, they'll remember you brought up that you interacted with that CEO. They'll go to that CEO who they actually have an active business relationship with them, and they'll ask that person about you. So you want that to happen in general. So if it's a highly specialized fund, you need to make sure that you kind of understand certain things about them. And if you bring up people in industry, oh yeah, I worked with that guy when he was in his first role as CEO, 8 years ago, and I was his head of biz dev or something like that. So sharing people in common with someone who's very specialized, who you can see their track record, you can make some inferences. There's people around those companies that or with further research, looking things up on LinkedIn or Crunchbase or one of the aggregators, FactSet, etc. You can sort of figure that out and go and refresh your memory, go and write down the names and the jobs, the companies they were at, etc. So you're not stammering for the name of the person in the company they worked at or whatever. That's wonderful validation. Also, one intriguing trend that I have seen just in the last 6 months is these very specialized venture funds. They're starting to talk about what I'll call full stack startups, increasingly. And so making sure you are familiar with the language, know what they mean. And this is such a strong trend, you might even need to pivot your business to be a full stack. So what full stack means is, in this case, and I think you'll hear this term increasingly, is that for a long time, software startups were software companies that sold software tools to enterprise. And the enterprise was in the market. So the enterprise was General Motors, and General Motors makes cars, and the software company doesn't make cars. The software company makes tools, software tools that it sells to General Motors for CAD or for something like that. And that's the way the market worked for a very long time. But we're seeing a new trend coming out where and the new trend is personified by Uber. So is Uber a software company? Do they sell software? They sell software to cab companies and trucking companies and logistics companies. No. Uber sells rides. Uber sells the deliveries. They don't sell software. And so, I would make sure you're familiar with cutting edge trends that these expert venture funds are going to be talking about. I have seen, a company, it's a software company in diabetes, go to a sort of a highly specialized fund and say, we want to sell more software for diabetes. And the response was to be in the diabetes care business and have clinicians and take responsibility for the patient and get the whole check for the patient, get a carve out of the whole check for the patient, and then solve the patient's diabetes problem. We don't want you to be just a software company. And so that company would have ideally known that perception shift in advance, and they could still go and pivot. They probably won't pivot, but they could still go and pivot and come back as a full stack company. So those are two differences. I would say is to know the people who you share in common going into for someone who's specialized who's been in the industry for a long time. And also to know sort of the cutting edge directions they want to take things, that they might turn you down. If you're just a software company for diabetes, they might turn you down flat because you're not full stack, and they have embraced a trend of only investing in full stack companies, for example.
There's kind of that tech enabled services trend, basically.
Yeah.
Sounds very simple.
So that is the newest. Sometimes we hear new terms for things. So there was crypto, and they became Web3. I don't know if you recall that. And so tech-enabled services is becoming full stack. There's a slight difference there between them, which is that tech-enabled services could be partial stack. Enabled services, that is the full thing from beginning to end. But full stack is a term coming out of B2B that is going to hit digital health. And so in the case of digital health, it is supporting the former controversial thesis of tech-enabled services companies, and it is the idea that sort of the black turtlenecks are going to go into care and beat the white jackets in care.
Right. So, yeah. To be seen. Well, Steve, this is a fascinating and informative conversation, just as fun as it was last time. And